The following podcast by Fusion Family Wealth, LLC, Fusion, is intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Please see additional important disclosure at the end of this podcast. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.
We don't seek out, from a human nature perspective, things that are going to benefit us over the long term. We have what's called a loss aversion bias. It simply means that the pain of a loss for us is felt 2.5 times more than the pleasure of a gain is felt pleasurable. So what we seek out is investments and activities that minimize the short-term chance of loss.
Welcome to the Crazy Wealthy Podcast with your host, Jonathan Blau. Whether you're just starting out or are an experienced investor, join Jonathan as he seeks to illuminate and demystify the complexities of making consistently rational financial decisions under conditions of uncertainty. He'll chat with professionals from the advice world, entrepreneurs, executives, and more to share fresh perspectives on making sound decisions that maximize your wealth. And now, here's your host.
Hey, welcome to another episode of Fix It Friday. Coming to you again from sunny Florida. Hopefully, those in New York will not avoid listening to the podcast out of envy. But hopefully, those who are watching will feel some of the warmth that's emanating from behind us. So today, I want to talk about what I believe are the two biggest threats to investor wealth. And those who are listening, from my experience, likely will be thinking of threats that don't fall into either of these two. So they might be thinking about things like volatility or bear markets, sometimes globally called crashes, or recessions, or political unrest. Now, a president who we feel is going to be damaging to the economy and so forth. And none of those that I just mentioned are one of the two biggest threats. So there's an external threat and an internal threat. And the external one is what I call inflation. Inflation just means that if I have $100 today and I perfectly preserve it for the next 30 years so that I still have $100, it didn't disappear, I've lost a lot of money. The rational definition to me of money is purchasing power. So my money hasn't kept up with the ability to increase the value of it to buy the goods and services at higher and higher prices. So in order for me to buy in 30 years what $100 bought today, I'll need about $250. So our investments need to be able to, at the very least, keep up with inflation, hopefully beat it. Most of the time, what happens is, from an investment standpoint, we as investors don't seek out the investments that historically have not only kept up with inflation, but beat it handsomely. Instead, we seek out investments that, if I call inflation the disease of money, we seek out investments that don't cure the disease, but carry the disease. And those are usually what we call bonds, fixed income investments. And so what happens with a bond, if I put $100 in a bond today, and I think if I get 5% a year for the next 30 years, in 30 years, I only get back $100. And what's worse, the 5% I was getting was frozen at 5% all the way through the time the bond matured. By year 30, I need 2.5 times the 5% to buy what inflation bought. I've long since run out of money because I've had to unwind the principal to keep up with the fact that the price of things kept going up and my investments weren't doing it. So why do we do that? Why do investors behave that way? We do it because we don't seek out, from a human nature perspective, things that are going to benefit us over the long term. We have what's called the loss aversion bias. It simply means that the pain of a loss for us is felt 2.5 times more than the pleasure of a gain is felt pleasurable. So what we seek out is investments and activities that minimize the short-term chance of loss and maximize the short-term chance of pleasure. The very investments that will get us to keep up and beat inflation are not that. Those are investments in real assets or companies that we can gain ownership of through stock certificates. So that's what people sometimes call the stock market. But the stock market has been remarkably protective against inflation, and bonds are actually destructive when it comes to wealth over time. So one of the things that that happens is we have also an ambiguity bias. We'd much prefer to buy and invest in things that we know in the long term probably won't do better than other things, as long as the things that we're talking about investing in don't have ambiguity, meaning there's some certainty affixed to the timing and the amount that we'll make on the investment. And that's characteristic of bonds. Stocks don't move in straight lines like that. They have ambiguity. And that's a bias that we have. We try to avoid making commitments to things that have ambiguity attached to it. So we kind of just need to be aware of that. One of the things that that this leads to now as a segue is the second biggest threat to money, and that's the internal threat. That threat is the investor themselves. So what happens is with all the biases that we have, I just described loss aversion, we tend to make the opposite decisions than the ones that we need to make for long-term success. And if we don't fight those biases and become aware of them, which we can do through all of the podcast series that the Fix It Fridays cover. So if you haven't heard all of them, you go back and look at all the ones out there. I cover a different kind of bias each time, and I think the collection of them will really begin to help people to see how they can overcome making these faulty decisions when it comes to their investments. Now, when I said that volatility and bear markets are not the threat, let me give you an example. In 1973, which was the beginning of the first of last 52 years, 50% decline in the stock market, 73 and 4. We had 350% or more declines since then in the last 52 years. So 73, 4 was the first, 2000 to 02 was the second, and 2008, 9, the credit crisis was the third. That one was actually down 60%. So in those 52 years, we had 3 halvings or more of the market. Including those 3 halvings, we had a total of 12 what are called bear markets, down 20% or more from recent highs. We also had 9 recessions. What also happened is the S&P went from 100 to 6,000, right? So it went up 60 times. Inflation went up only 8 times. So stocks didn't just help us keep up with inflation. It actually increased our cost of living about 6 times more than inflation. Means that we could buy six times the goods and services inflation adjusted that we did 52 years ago. Dividends that get paid to us as shareholders in the form of quarterly cash payments from the companies that we own increased 24 times during that period, while inflation was up 8 times. So the message is that volatility and bear markets didn't hurt anybody. The only one who suffered from those are the investors who took the temporary declines during the bear markets, for example, and created a permanent loss by humanly manufacturing it, by selling, by reacting into the fear and selling and going to cash. The S&P 500 is basically at new all-time highs today. Nobody has ever lost money in it other than if they created the loss themselves by reacting. And when we talk about bonds, by the way, I'll just interject with this. It's not that I don't believe in bonds at all. I just don't believe that bonds should be in a portfolio to mute volatility or up and down movements over the long-term average, because that's not a real risk. Bonds should be there to protect us against what's called sequence of return risk. So if we're retiring next year and the next 2 years and the markets might be down 30 or 40%, I don't know that sequence is ahead of me. I don't know that the next 1 or 2 years will be down and to what magnitude. So to protect against that potential, I want to have 2 to 3 years of bonds set aside so that I can switch my spending in retirement to that pool of capital and not be forced to sell stocks while they're temporarily down. And the reason I suggest 2 to 3 years is going back in history, the average from a peak in the stock market to a trough, a bottom, and back to a new high has taken 40 months. So as long as we have 2 to 3 years in spending set aside, we can protect against the sequence of return risk. The other thing I want to talk about is gold, because everybody thinks gold is a good inflation hedge. So going back to 1980, when the S&P was 100 and today is 6,000, so it's gone up 60 times or so. Gold back in 1980 hit a peak when the inflation that peaked in 1979 under Jimmy Carter's presidency was actually battled when Paul Volcker came in as the Federal Reserve Chairman and had to spike interest rates very high to break the back of that inflation. And so gold peaked as a perceived inflation hedge at $800 an ounce. Today, it's under 3,000. So let's say it's gone up about 4 times. Stocks have gone up 50 times. By the way, inflation has gone up 3.5 times in that period. So gold barely kept up with inflation. So I call gold as an inflation hedge a little bit of a myth. Most people would have been better off buying comic books and saving those to hedge against inflation. There is a fourth risk that I'll just touch on lightly. The media and the financial industry doesn't like to tell people that all you need to do is buy a diversified portfolio of index funds and stay with it and let it compound, because they only make money when people are nervous or take action. Right? The investment firms wouldn't make money if everybody was just putting their money in low-cost index funds. They like to sell hedge funds. They like to sell all different products to keep the cash flow coming in. Same for the media. If the media said all you have to do is compound and buy index funds, nobody would tune in to see what they need to do in response to today's news with their portfolio, which is they should do nothing. But the point is, the media and the industry are actually another threat to investors. I call them both wolf in sheep's clothing. So with that, I hope you enjoyed this episode of Fix It Friday, and you can get us on all your favorite podcast venues and crazywealthypodcast.com, as well as our website, fusionfamilywealth.com. Till next time, Jonathan Blau, signing off.
Thank you for tuning in to another episode of the Crazy Wealthy Podcast. For more insights, resources, and to sign up for our newsletter, visit crazywealthypodcast.com. Until then, stay crazy wealthy.
The previous podcast by Fusion Family Wealth, LLC, Fusion, was intended for general information purposes only. No portion of the podcast serves as the receipt of or as a substitute for personalized investment advice from Fusion or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation. Neither Fusion's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Fusion is engaged or continues to be engaged to provide investment advisory services. Fusion is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the video content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Fusion is engaged or continues to be engaged to provide investment advisory services. A copy of Fusion's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fusionfamilywealth.com.